All right, let's talk about the Federal Reserve. We're going to dig into the Fed's playbook and see how it actually steers the U.S. economy these days. Because, spoiler alert, the way they do it has completely changed.
So let me just ask you this. Is your old econ textbook basically a historical document now? Because yeah, there's a really good chance that whatever you learned in school about how the Fed controls money, it's just not true anymore. The whole system has been flipped on its head, and you really need to understand this new world to make sense of the economy today. You see, for decades, the Fed played the game in what we call a limited reserves world. They could just add or subtract a little bit of cash in the banking system to, nudge interest rates up or down. But that's the old way. Today, we're in a world of ample reserves, meaning the system is absolutely flooded with cash, and that has changed everything. The old moves just don't work.
So how in the world did we get here? Well, the story of this massive shift really gets going with the 2008 global financial crisis. That event was such a bombshell that it forced the Fed to basically tear up its old rulebook and start from scratch.
And just to give you a sense of the sheer scale of this change, let's throw some numbers out there. Back in 2007, right before the crisis hit, the total amount of reserves, and that's just the cash that banks hold, in the entire U.S. banking system was about $15 billion. Okay, remember that number.
Now, fast forward. To fight the crisis, the Fed opened the floodgates. They unleashed a tidal wave of stimulus to keep the economy from collapsing. And by 2014, that $15 billion number, it had exploded to a mind-boggling $2.7 trillion. Suddenly, the entire system was just swimming in cash.
And here you can see the problem this created. In the old days, the Fed would just make these tiny adjustments to the money supply to move the interest rate. But now, with so much cash in the system, that old tool is like trying to change the ocean's water level with a teaspoon. It just has no effect. It simply doesn't work anymore.
Okay, so the old playbook is useless. The Fed is facing this completely new reality. It desperately needed a brand new toolkit, right? It had to figure out a new way to manage interest rates when its main weapon was suddenly obsolete.
So, what's tool number one in this new kit? It's called Interest on Reserves, or IOR. This is super important. It's basically an interest rate that the Fed just decides on. It's what the Fed pays commercial banks for the money they just leave parked at the Fed. And think about it. Since it's a totally risk-free return, no bank is going to lend money to someone else for less than they can get from the Fed, right? So just like that, it becomes the Fed's new primary lever.
But, it's never that simple. There's a little wrinkle here, a complication that brings us to the second tool, the overnight reverse repo rate, or ONRRP. You can just think of this as a backup plan. It's a supplementary tool that's absolutely critical to making the whole new system hang together.
So why do they even need a backup?
Well, here's the thing. Not everyone playing in these big money markets is a traditional bank. You've got these huge players like money market funds, and they aren't allowed to earn that interest on reserves we just talked about. So the ONRRP is their backstop. It puts a floor under the market, so the overall interest rate can't fall below where the Fed wants it. So let's put it all together. How do these new tools actually work in practice? Well, they create this really clever new setup for controlling rates, which everyone calls the corridor system. And here's that new rulebook laid out. At the very top, you have the discount rate. That's what the Fed charges banks for emergency loans, so that acts as a ceiling. At the very bottom, you have that ONRRP rate we just talked about. That's the hard floor. And then smack in the middle, you have the interest on reserves. That's the main dial the Fed turns to steer everything inside that corridor. This really shows you how it all works. You can see that corridor, that lane created by the rates the Fed controls. And the actual market rate, the one you hear about on the news, the federal funds rate, it gets neatly guided to stay right inside those boundaries. So instead of nudging the money supply, the Fed now just moves the whole corridor, the floor and the ceiling, up or down together. So what keeps everything from flying off the rails? What keeps the market rate inside this corridor? Well, it's a super powerful force in finance called arbitrage. As this quote says, if the rates ever drift apart, it creates a chance to make risk-free money, and traders will jump on that in a nanosecond. They'll borrow where it's cheap and lend where it's expensive, and that action itself snaps the rates right back in line with the Fed's target.
Okay, that was a lot of technical stuff. But why should you care? What does any of this actually mean for you? Well, it matters a lot because the Fed's control over these rates, that directly connects to the interest rates on your mortgage, your car loan, and your credit card bill.
And get this, because this is so important. Financial markets never wait. They are all about what's going to happen next. Just look at this.
You can see that mortgage rates and business borrowing costs started shooting up way back in early 2022. That was months before the Fed even started its official rate hikes. The market was already reacting to what it knew the Fed was about to do.
But the story doesn't end there. When the Fed makes a move, those changes ripple through the economy. But it's not like flipping a light switch. It takes time. Economists have a famous phrase for this. They say the effects happen with long, variable, and highly uncertain lags. It takes a while for higher rates to actually change people's spending habits and cool down the economy.
And, that really leaves us with the billion-dollar question, the one that everyone, from central bankers to investors to you and me, is asking right now. With all those long and uncertain delays, how do you know when you've done enough? How do you tame inflation without accidentally crashing the economy? That's the tightrope the Fed has to walk every single day.